You got another raise this year, 5%, maybe 7% if you negotiated well. Your salary is higher than it's ever been. You should be saving more money than last year, building wealth faster, finally getting ahead. Instead, you look at your savings account and it's basically the same number it was 12 months ago. Maybe it's even lower. You're making more money than ever, and somehow you have less to show for it than when you were earning $20,000 less. This isn't bad luck, and it's not because you're irresponsible with money. It's because the math of building wealth in 2026 is completely broken, and most people don't realize it until they've wasted years of raises on nothing. My name is Alicia, and I've watched people get raise after raise while their net worth stays frozen or even decreases. If you're making more money than you did 2 years ago, but your savings haven't grown proportionally, or if you want to understand why your raises are disappearing before they can build wealth, make sure to subscribe to the channel and hit that like button if this information helps you out. Here's what's supposed to happen when you get a raise. You were living on $60,000, you got bumped to $65,000. That extra $5,000 per year should go straight to savings or investments. Your expenses don't magically increase just because your paycheck got bigger, right? So that raise should translate directly into wealth building. Except it doesn't. Not even close. For most people, raises disappear completely within 3 to 6 months, consumed by a combination of factors that nobody warned them about. Let me show you exactly where your raise went and why your savings didn't grow even though you're earning more. Meet Daniel. 2 years ago, he was making $62,000 a year. He just got his second annual raise and he's now making $70,000. That's an $8,000 increase over 2 years. $8,000 more dollars annually should have added at least $16,000 to his savings over that period, probably more if he invested it. Instead, Daniel's savings account has grown by exactly $2,000 in 2 years. He has no idea where the other $14,000 went. Here's what actually happened to Daniel's raises, and it's the same thing that's happening to you. First, taxes ate a huge chunk before he ever saw the money. When Daniel went from $62,000 to $65,000, that $3,000 raise became about $2,100 after federal taxes, state taxes, Social Security, and Medicare. Already lost $900 to taxes. When he went from 65 to 70, that $5,000 raise became about $3,400 after taxes. Lost another $1,600 to taxes. His total $8,000 in raises only put about $5,500 extra in his pocket. He lost $2,500 to taxes before he could even think about saving it. Most people don't account for this. They get excited about a $5,000 raise and mentally budget for $5,000 more dollars. But that's not how taxes work. You're not getting the full raise. You're getting the raise minus roughly 30 to 35% for taxes, depending on where you live and your tax bracket. That's the first place your raise disappeared. But it gets worse. Inflation in 2025 and 2026 has been running around 4 to 6% annually, depending on what you're measuring. Daniel's cost of living went up significantly over those 2 years, even though he didn't change his lifestyle at all. His rent increased by 6% when he renewed his lease. That's an extra $180 per month, $2,160 per year. His car insurance went up 15% because rates are insane right now. That's another $40 per month, $480 per year. His groceries cost about 20% more because food inflation has been brutal. If he was spending $400 a month on food, that's now $480, costing him an extra $960 per year. His utilities increased. His phone bill increased. His streaming services increased their prices. His gym raised their rates. Every single recurring expense in his life got more expensive, and collectively these increases ate up about $4,000 of his after-tax raise over 2 years. He's not spending more money on fun stuff or upgrading his lifestyle. He's spending more money on the exact same things he was buying 2 years ago because everything costs more now. Let's pause and add this up. Daniel got $8,000 in raises. Taxes took $2,500, leaving $5,500. Inflation on his existing expenses took $4,000, leaving $1,500. He should still have $1,500 of real purchasing power increase from his raises. That should be in his savings account. Where did it go? Here's where it gets really insidious. Lifestyle creep happened so gradually that Daniel didn't even notice it. When he got his first raise from $62,000 to $65,000, he felt like he could finally afford to live a little better. He upgraded his apartment from a studio to a 1-bedroom because he's almost 30 and living in a studio feels depressing. The one-bedroom costs $300 more per month than his studio. That's $3,600 per year. He justified it because he got a raise and he deserves to live in a decent space. He also finally got rid of his 15-year-old car that was constantly breaking down. He bought a 3-year-old certified used car, which was responsible compared to buying new, but it came with a $250 monthly payment. That's $3,000 per year he wasn't spending before. He justified it because his old car was unreliable and he got a raise so he could afford a car payment now. These two decisions alone, the apartment upgrade and the car payment, consumed $9,300 of his raise. But remember, his after-tax raise over 2 years was only $5,500, and inflation already ate $4,000 of that. So these lifestyle upgrades weren't funded by his raise at all. They were funded by money he should have been saving. This is why his savings barely grew, despite getting $8,000 in raises. But Daniel still doesn't understand where his money went, because these decisions felt reasonable at the time. He wasn't being reckless. He didn't buy a luxury car or move into a penthouse. He just upgraded from a studio to a one-bedroom and bought a reliable used car. These are normal adult decisions that millions of people make. The problem is that normal adult decisions in 2026 cost so much that they completely consume raises that would have built significant wealth if left untouched. This is the fundamental problem with savings growth in 2026. The gap between getting a raise and actually having more money to save has become enormous. Your raise gets hit by taxes first, reducing it by 30 to 35%. Then inflation eats another chunk by making all your existing expenses more expensive. Then lifestyle creep consumes whatever is left because you feel like your increased income should translate to an improved quality of life. By the time these three forces are done with your raise, there's nothing left to save. Let me show you this with real math. You make $70,000 and you get a 5% raise to $73,500. That's a $3,500 raise. After taxes, it's about $2,400 in your pocket. Inflation running at 5% on your existing expenses, let's say $50,000 annually, costs you $2,500. You're already negative $100 before you've made a single lifestyle change. Your raise didn't even keep up with inflation on your current lifestyle. You'd need a 5% raise just to maintain your current standard of living, and anything beyond that is actual progress. This is why people feel like they're falling behind even when they're getting raises. Because they are falling behind. A 3% raise when inflation is 5% means your purchasing power decreased by 2% even though your salary went up. You're making more money and you're poorer than you were last year. The number in your paycheck increased, but what that number can actually buy decreased. Now let's talk about what I call tax bracket creep. And this is destroying people's ability to save in 2026. When you get a raise, you don't just pay more taxes because you're earning more total dollars. You might also move into a higher tax bracket where each additional dollar is taxed at a higher rate. Daniel making $70,000 is in the 22% federal tax bracket. If he gets a big raise to $85,000, part of that new income gets taxed at 24%. He's making more money, but keeping less of each additional dollar. This gets worse in high-tax states. If you live in California or New York or New Jersey, you're paying state income tax on top of federal. A $70,000 salary in California has an effective tax rate around 28 to 30%. A $90,000 salary might be 32 to 34%. Your raise is getting hit with a higher marginal tax rate than your base salary, meaning you keep even less of it than you expect. Nobody explains this to you when you get promoted or switch jobs. They tell you your new salary, and you calculate what your monthly income should be based on your current tax rate. Then your first paycheck arrives and it's less than you expected because you didn't account for bracket creep. You were planning to save that extra $400 per month from your raise, but your actual take-home only increased by $270. Where do you think that missing $130 per month goes? It goes to taxes, and it never had a chance to build wealth. Here's another factor destroying savings growth in 2026: the erosion of employer benefits. 10 years ago, a job paying $60,000 might have included full health insurance coverage, matching 401k contributions, maybe a pension. Now a job paying $75,000 might have health insurance with a $5,000 deductible, a 401k match that only kicks in after you contribute 6%, and definitely no pension. Your salary increased, but your total compensation might have actually decreased once you account for worse benefits. Daniel's health insurance at his new higher salary requires him to contribute $200 per month from his paycheck. His old job covered it fully. That's $2,400 per year of his raise gone to health insurance he used to get free. His dental and vision are separate now, another $60 per month, $720 per year. His company changed the 401k match from dollar for dollar up to 4% to 50 cents on the dollar up to 6%. To get the same match he used to get contributing 4%, he now has to contribute 6%. That's another $90 per month, over $1,000 per year. These benefit changes are invisible if you're not paying attention, but they're consuming thousands of dollars annually from raises. You think you got a 10% raise, but after accounting for worse health insurance, worse retirement benefits, and higher out-of-pocket costs for things your employer used to cover, your actual compensation might have only increased by 4 or 5%. And that's before taxes and inflation. Let's talk about subscription creep, because this is quietly destroying everyone's savings without them noticing. Daniel had Netflix and Spotify when he was making $62,000. Seemed reasonable, $20 per month combined. Over the next 2 years, as his salary increased, he added Disney Plus because everyone was talking about shows on it, then HBO Max for specific series, then YouTube Premium because the ads were annoying, then a news subscription because he should stay informed, then a meditation app because he's stressed about money, then a meal kit service because he's too busy to shop. Each decision seemed tiny. $10 a month here, $15 there. But Daniel is now spending $135 monthly on subscriptions, $1,620 annually. When he was making $62,000, he was spending $240 on subscriptions yearly. That's a $1,380 increase in subscription spending alone. He didn't make a conscious decision to spend $1,300 more on subscriptions. It just accumulated gradually as services kept launching and his income kept rising, and he felt like he could afford each individual addition. This is lifestyle creep in its purest form. Every subscription seemed affordable in isolation. $10 a month is nothing when you're making $70,000 a year, but $10 here and $15 there and $20 over there adds up to over $100 monthly. That's disappearing from your savings potential. Multiply that across every category of spending: food delivery services, upgraded phone plans, convenience purchases, and you've got hundreds of dollars monthly being consumed by lifestyle creep that happened so gradually you didn't even notice it. Here's what makes this particularly destructive. These subscriptions and lifestyle upgrades create a new baseline for your spending. When Daniel was making $62,000 and spending $4,000 monthly, a raise to $65,000 should have meant $300 extra monthly to save. But his spending increased to $4,300 monthly through apartment upgrades, car payments, more subscriptions, and general lifestyle inflation. Now when he gets another raise to $70,000, he's starting from that $4,300 baseline instead of the original $4,000. His expenses have ratcheted up permanently. This is why people making $100,000 feel just as broke as they did making $60,000. Every time their income increased, their expenses increased to match or exceed it. They never captured the raise for savings because they immediately allocated it to lifestyle improvements. And now they're stuck at that higher spending level, unable to go back without feeling like they're depriving themselves. Let me show you what actually needs to happen when you get a raise if you want your savings to grow. You make $70,000 and you get a $5,000 raise to $75,000. That $5,000 becomes about $3,400 after taxes. You need to immediately, before that first higher paycheck hits your account, set up an automatic transfer of that entire $3,400 annual increase straight to savings or investments. That's $283 per month that moves automatically before you can spend it. Your checking account should never see that raise. If the money hits your checking account, you'll spend it. Guaranteed. You'll upgrade something or increase your discretionary spending or subscribe to something new or eat out more often. The money will evaporate and you'll wonder where it went. But if it automatically transfers to savings before you can touch it, you'll adjust to living on your previous income because you have no choice. And your savings will actually grow. This is what people who build wealth do differently. They don't let raises hit their checking account and then hope they'll have discipline to save what's left. They automate the savings increase the moment the raise takes effect. Their lifestyle stays frozen at their previous income level while every raise gets captured for wealth building. This feels restrictive and unpleasant. It feels like you're not getting to enjoy your success, but it's the only way raises actually translate into growing savings. But even this strategy has problems in 2026 because of inflation. If you're saving your entire raise but inflation is eating your existing savings, you're not really getting ahead. Your savings number might increase, but its purchasing power stays flat or even decreases. You saved an extra $3,400 this year from your raise, but if your existing $50,000 in savings lost 5% of purchasing power to inflation, that's $2,500 of value gone. Your net real savings only increased by $900 even though you saved $3,400 of your raise. This is why people feel like they're running on a financial treadmill. They're doing everything right, saving their raises, avoiding major lifestyle inflation, being responsible. But inflation is quietly destroying their progress faster than they can build it. Your savings account balance goes from $50,000 to $53,400 and you think you made progress. But if inflation was 5%, you needed your savings to grow to $52,500 just to maintain the same purchasing power. Your real gain was only $900, not $3,400. Here's what you actually need to do in 2026 to make your savings grow despite raises being consumed by taxes, inflation, and lifestyle creep. First, you need to get aggressive about tax optimization. Max out your 401k contributions because that reduces your taxable income. If you can contribute $23,000 to your 401k, that's $23,000 of income you don't pay taxes on currently. You'll pay taxes when you withdraw it in retirement, but you've deferred that burden and the money compounds tax-free in the meantime. Use a health savings account if you have a high-deductible health plan. HSA contributions are tax-deductible, grow tax-free, and can be withdrawn tax-free for medical expenses. It's the best tax-advantaged account available, and most people don't use it. Consider a Roth IRA for after-tax contributions that grow tax-free forever. The point is to minimize the 30 to 35% of your raise that goes to taxes so more of it can go to building wealth. Second, you need to track every dollar of lifestyle creep and actively fight it. When your rent increases, don't just accept it. Can you negotiate? Can you move somewhere cheaper? Can you get a roommate? When subscriptions increase their prices, cancel them. When you're tempted to add a new subscription, ask yourself if you'd rather have the subscription or have that money invested. Most people would rather have the money invested, but they choose the subscription because it's a small amount and they're not thinking about compound growth. Third, you need to increase your savings rate faster than inflation. If inflation is running at 5% annually, your savings need to grow by more than 5% to represent real progress. This means you can't just save your raise and call it good. You need to save your raise, plus cut existing spending, plus find ways to earn additional income. You need multiple engines working simultaneously to overcome the inflation headwind. Fourth, you need to get your money out of savings accounts and into investments that can actually outpace inflation. A high-yield savings account earning 4% is losing purchasing power when inflation is 5 or 6%. You need your money in index funds or real estate or other assets that historically grow faster than inflation. Yes, these investments have volatility and risk. But keeping all your money in cash guarantees you're getting poorer every year even as the number increases. Let me show you what this looks like in practice. Emma makes $68,000. She gets a $4,000 raise to $72,000. After taxes, that's about $2,700 extra annually. Instead of letting it hit her checking account, she immediately increases her 401k contribution by $225 per month. That money goes straight to investments, never touches her checking account, reduces her taxable income. She keeps her rent the same by renewing her current lease instead of upgrading apartments. She audits her subscriptions and cuts $40 monthly of services she rarely uses. She takes that $40 and routes it to a Roth IRA. Her total monthly savings increase is $265. Over a year, that's $3,180 added to investment accounts that will grow at 8 to 10% instead of eroding in a savings account at 4%. After 1 year, her investments grew by $3,100 from contributions plus another $800 from market returns. Her actual wealth increased by $3,900 in real purchasing power even after accounting for inflation. Compare this to Daniel, who got a similar raise, but let it hit his checking account, upgraded his lifestyle, and ended up saving almost nothing. Same raise, completely different outcome. Emma's net worth is growing. Daniel's is stagnant despite his higher salary. Here's the uncomfortable truth. Your savings isn't growing in 2026 because you're letting the system consume your raises instead of fighting to capture them. Taxes take their cut automatically. Inflation erodes your purchasing power automatically. Lifestyle creep happens automatically when you don't actively resist it. The default path leads to stagnant savings despite rising income. Building wealth requires fighting against all three of these forces simultaneously, and most people either don't realize they need to fight or they don't have the discipline to do it. Your raises are real. The money exists, but it's being diverted before it can build wealth through a combination of tax policy, inflation, and your own spending decisions. If you want your savings to actually grow, you need to intercept your raises before these forces consume them. Automate your savings increases. Optimize your taxes. Resist lifestyle inflation. Invest in assets that outpace inflation. Do all of this consistently every single time you get a raise, and your savings will finally start growing the way they're supposed to. Or keep doing what you've been doing, keep wondering where your raises went, and keep having the same amount saved 5 years from now despite earning $30,000 more. The choice is entirely yours.